Welcome to our channel. Today, we're diving into a key development in the Indian financial market, the recent interest rate cut by the Federal Bank and how it's impacting debt funds. Whether you are a seasoned investor or just getting started, understanding this move is crucial for your portfolio. First, let's take a quick look at what happened. The Federal Bank recently lowered its interest rates to manage the US national economic concerns. This decision has triggered a ripple effect across global markets, including India. But how does this affect debt funds, particularly in the Indian market? In simple terms, when interest rates fall, existing bonds with higher interest rates become more valuable, since they pay better than new bonds issued at the lower current rates. As a result, the prices of these existing bonds increase. However, there's a catch. While bond prices go up, the future income or yields from newly purchased bonds will be lower. So, while your bond fund might show gains in the short run due to capital appreciation, the ongoing interest payments from new bonds will decline. This is especially true for long-duration debt funds. These funds tend to benefit the most from falling interest rates, as they hold bonds with longer maturities, which react more sharply to rate changes. So, while the yield on new investments might be lower, the returns on your existing bond fund could actually improve through higher net asset value. One type of debt fund that deserves special attention in this environment is dynamic bond funds. These funds adjust their portfolio duration based on interest rate movements, allowing flexibility to switch between short-term and long-term bonds depending on the market conditions. This makes them more resilient during volatile periods. Let's take a look at some popular dynamic bond funds in India that investors are keeping an eye on. First, ICICI Prudential All Seasons Bond Fund. This fund adjusts its portfolio across various debt instruments depending on interest rate trends, aiming for consistent returns across different market phases. Second, HDFC Dynamic Debt Fund. With a flexible approach, this fund actively manages its portfolio to maximize returns, especially during changing interest rate environments. Let's look at an example. In July 2020, when the Reserve Bank of India (RBI) cut interest rates, the average return from dynamic bond funds jumped. For instance, HDFC Dynamic Bond Fund delivered returns of around 9% in that year, compared to the previous year's 3.23%. Similarly, the ICICI Prudential All Seasons Bond Fund saw its returns increase from 10.16% to a notable 11.8% during the same period. So, what should you as an investor do? If you're holding short-term debt funds, you might want to reassess your strategy. Consider switching to long-term debt funds that offer some cushion against interest rate fluctuations. That's it for today's update on how the interest rate cuts will affect the debt funds in India. If you found this breakdown helpful, don't forget to like and subscribe for more updates on how macroeconomic events shape your investments. Stay informed, stay ahead.